all this fuss about interest rates is kind of a tempest in a teacup. It's really a second order or third order kind of condition in a mathematical sense. The first order condition is what's going on with the money supply. Monetary policy is determined by changes in the money supply. And once the money supply has a significant change with quite long lags, a year and a half, you start getting changes in economic activity and inflation. And right now, the year-over-year rate of growth in the money supply measured by M2, David, is 1.26% per year. That's way below Hanke's golden growth rate of 6% per year, a rate consistent with hitting the Fed's 2% inflation target. So the money supply has really been growing, actually contracting, literally contracting since July of 2022. That's only happened 4 times in the history of the United States, or I should say the history of the Fed, since 1913. And all of those 4 contractions led to recessions. Actually, one of them, 1929 to 1933, led to the Great Depression. So this is just nonsense. This talk about, even Jamie Dimon, who usually is very sensible about things, is talking about the possibility of stagflation. It's just not going to happen. What you're going to have is continued downward movement in the headline CPI as well as the PPI because of this monetary slowdown and contraction we've had. That's baked in the cake. That is caused by the monetary contraction that started a long time ago. That's why it's baked in the cake. So what they did today is pretty much irrelevant. Don't get excited about this. This is people who are they're so drilled in the head with this data dependency. They're looking at these little tweaks and movements and think it's very significant. It's irrelevant right now. We'll worry about it if it gets up to 6%, and we'll not worry about it. Actually, we'll be happy when it gets back up to 6%. We'll start worrying about it if it gets significantly above 6%. So people are looking at the wrong thing. They don't understand what they're looking at. They're looking at a chart and they see a little zig or a little zag and they think it's a big deal. No, it's irrelevant. The inflation is declining. It's 2.5%. It will continue to go down. It'll probably go below the 2% target next year sometime because we've had this big contraction in the money supply. And all Powell did in his speech, he's an expert con artist. He's conned everybody. I like all the reporters in the audience taking notes and being conned by him. He essentially was saying, we have all the gauges just right. We know exactly what we're doing. And folks, we're geniuses. We're going to have a soft landing. No, we're probably going to have a hard landing and a recession because of this contracting money supply that I mentioned. That's baked in the cake. So not only the inflation is under control and coming down, but there's a little something behind the curtain, and that is the next shoe is going to drop, and that will be a recession. So,
okay.
So it's not going to be stagflation. It's not going to be low growth and more inflation, as Jamie Dimon indicated we might have a problem.
Yes.
The recession combined with inflation, it's the worst of all possible worlds. So it is what stagflation is bad news. And the model says if you get a big change, a 50 basis point increase in the unemployment rate, you're in a recession. And we've had that. So that is basically telling us that we're already in a recession, if that's the metric that you're using and the model that you're using. And the New York Times reporters reported on this, as well as every other reporter in the world. So she wanted him basically to knock that story down. This is number one. All these clips? You're in the spin room. This is a Fed spin room in there. So you got to think. People have to put things in context. What is going on? The Fed is spinning the narrative, and the press is going to echo the narrative. Now, this is a perfect example of the problems you get into with data dependency. Yeah, some of the data looked good bad a few weeks ago. Then it looks better. Then it looks bad. It's all over the place. This data dependency stuff. This day-to-day data are irrelevant. They're second order conditions. So forget it. What you didn't get was a question, and you will not get one from the reporters because they don't understand it. You will not, and the Fed doesn't want to hear the question. That's the main reason. No one asked what's going on with the money supply and what has been going on with the money supply since July of 2022. If they would have asked that, he would have said it's contracting, and that usually leads to a recession, not a soft landing, and it's growing at way below the golden growth rate of 6%. It's growing at 1.26%. And that means trouble ahead. But that's not the spin. You think Powell is going to get up there and say, we've screwed everything up. We haven't been watching the money supply. We let it contract. And sure enough, that always leads to recessions. He did say one thing, by the way, and what Powell said, he said we're going to keep shrinking the balance sheet. Remember, you asked me about that. That was a very important thing.
Yes.
That's a lot more important than the Fed funds thing. That means quantitative tightening will continue, and it means we're not going to get the money supply shooting up anytime soon. That's what that means. Oh, it's just the rate of change is increasing a little bit.
Yeah.
It's not increasing very much. And we get that because remember, the biggest contributor to M2 has nothing to do with the Fed. It's the commercial banks. And the commercial bank credit is growing very slowly at about 3%. That's a number that's still below that's growing at 3%. The Fed isn't contributing very much. And you end up with an overall picture of a 1.26% year-over-year growth, which is very slow. He's so far behind the curve, it's unbelievable. I mean, this data dependency thing, by the way, if you're looking at day-to-day data, he's looking in the rearview mirror. He's not even looking forward. To look forward, you would have to look at what the changes were in the money supply and predict what impact with a lag those would have on economic activity and inflation. That's what's called monetarism, by the way. Hot plot thing is a lot of BS because number one, it's only about interest rates. It's not about the money supply and what's happening to the balance sheet of the central bank or what's happening to the commercial bank credit. But this is all this dot plot thing. They're trying to manage expectations. That's what they call it. It is kind of aggressively interfering with what's going on with the Fed. But forget that. It shows you that the staff who wrote the letter doesn't really understand what's going on because they're just focusing on the interest rate. They never talked about the Fed's balance sheet. They never talked about quantitative tightening. They never talked about the fact that the money supply is contracting in the United States and growing at a very slow rate. That is why the Fed's behind the curve. So they got the whole reasoning and logic wrong because the staff who wrote the letter, believe me, the senators had no clue of what was going on. Some staff person on Capitol Hill wrote it, so the staff person didn't understand anything. Changes in the money supply cause changes in inflation, and bond yields follow changes in inflation. End of story. What they do with the money supply, and that will determine what happens to inflation, and that will determine yields in the bond market. Why has the 10-year bond been such a great long trade ever since I recommended trading it when it was yielding 4.8%? Now it's down about 3.7, a little under 3.7. So that's been a huge capital gain, because as inflation came down, the yield on the 10-year came down, David. And when the yield on the 10-year comes down, of course, the price of the 10-year goes up.